Welcome to America's Heroes Group.
And welcome back to America's Heroes Group, this time with our roundtable and our partner, Katz Milanec, Incorporated. Today is Saturday, August 20th, 2022. August is National Wellness Month. You just heard our host, Cliff Kelley, at the break. My name is Sean Claiborne, and co-host, Army National Guard veteran. Our executive producer is Glenda Smith. Our digital media producer is Ivan Ortega of Scouts Arnold Productions. And we have Mr. David Milanec on the line with us right now. He's a CPA and president and founder of Katz Milanec Incorporated and a military family member. And we want to talk about a deadline coming up for those of you that might have filed extensions or maybe you have a corporation or a partnership. September 15th is quickly approaching, and that is a deadline very important to tax filing. How you doing, Dave?
I'm doing good, and yeah, you're correct. It's a very important deadline because as corporations and partnerships, both of those are pass-through entities, so that means you get taxed on your personal tax return for it. However, because there's no actual federal tax liability, if you are late filing a partnership or S corporation tax return, you incur a $200 per month per shareholder penalty for each month that you are, or part of a month that you are late. Man. Now, what that means is on September 16th, you are considered part of a month late. That's a $200 per shareholder penalty. October 1st, you are now 2 parts of a month late. So that is $400 per shareholder. And it goes all the way to a maximum of 12 months, so you can have up to a $2,400 per shareholder penalty if you are late on filing these returns.
Wow. So it seems like business owners always have a lot to juggle. And one of the things that I always personally feel like, and I think a lot of business owners would agree, is that they seem like they get hit really hard with taxes. So what are some things that business owners can do to protect themselves and save money?
Well, see, I'm sure this is, and I know this is something that's talked about in the military a lot. If you fail to plan, you plan to fail, right? Mm-hmm. So if you are a business owner, right now is actually, yes, you need to get your filings in for last year, but right now is actually the time for this year to start figuring out your tax plan. How much are you projected to make? How much would you owe based on how much you're projected to make? Okay, so let's say you owe $30,000 based on what you're projected to make. Well, if we can go out and buy, a vehicle for your company, or we can go out and buy some sort of equipment for your company that's going to allow you to write that off fully this year. By the way, this year is the last year for 100% bonus depreciation. It starts going down starting next year. It goes down to 80, then 60, then 40, then 20. So it's now is a good time to be looking at that and say, okay, so I can go buy this, and if I buy this equipment, it's going to take me from a $30,000 tax liability to a $15,000 tax liability. Okay, I'm more comfortable with $15,000. Let's go with that. Let's go with that as a plan.
Now, what about using retirement vehicles like 401ks or creating a set plan for yourself or your business? Describe those and how are they helpful for reducing income?
Yeah, so a SEP IRA or SEP 401k is something that's available to any business owner. It's effectively a retirement savings vehicle. Anybody who owns a business can start one for themselves. You are eligible to put there's a limitation of either 25% of your income, or I believe it is about $52,000. So you max out at $52,000, even if it's less than 25% of your income. But you also are subject to a second cap of 25% of your income. So, for example, if you make $160,000 that you're reporting as profit, well, you can only put $40,000 of that into that SEP IRA then. But basically, that will allow you to take that money and reduce it as taxable income, and therefore not have to pay the taxes on that money. But bear in mind that means that becomes a traditional IRA account, and so then you have to then you have to then you have to pay the taxes on that when you pull that money out.
Mm-hmm. So when you turn 59 and a half, then you have to you can start taking money out. But if you take it out prior to that, you have to pay a 10% penalty and all those types of different things.
10% penalty plus the taxes on it.
Right. So now what about cash balance plans? I know that's something that people don't use often, but people that have a lot of money stashed away and trying to figure out how they can pay themselves, so to speak. How does a cash balance plan work to try to put money into a retirement plan, reduce income, and also save money?
Cash balance plan. I don't know 100%. I'm not 100% familiar with that specific thing.
It's not a
can
real.
You explain it a little bit to me?
Yeah, the cash balance plans I've seen in the past where businesses, if they have a lot of money saved up, but they don't want to pay themselves that money, particularly if they're getting ready to sell a business or get out of the business. So what they do is they funnel it through a cash balance plan. And essentially, what it is like a retirement plan. There's a lot of rules and regulations on how it's done. You have to have an actuary actually come and pull together the numbers for you and to show how much money you can put in the plan. And once that's determined, you can basically siphon off money, go into your retirement plan. It reduces the business income or reduces your personal income as well. But then when you leave the business or sell the business, then you can roll it over into an IRA or get the money out of the business that way. So you're not having to claim it as income, but you can do much larger amounts of money than a typical SEP IRA or a traditional Roth IRA or anything along those lines. So it gives you way higher balances you can use.
That's definitely something that I'll have to look into. Then I've never seen that specific thing talked about before. In all honesty, I'll have to look into that and see what the advantages are. I mean, obviously, what you're saying is that you'd have a lot more that you'd be able to put in there for like retirement or what have you, and then that way it's also not taxed, which obviously is very advantageous. So yeah, I mean that's definitely something to take a look at and see what can be done there.
Yeah, I've only seen it used once in practice, and it was kind of complicated. I remember the people that I knew, they had a business and they sold it, and they were putting a lot of money into it. It was like the balances are way higher. I think it was like close to almost like $1 million or something like that they were able to but it was done over a certain period of time, so many years ago, of course. So they were able to get more money into a plan without having to claim all that money as income. They're not the easiest things in the world to do, but they're out there and they're successful. I guess people have been using that for a little bit of time.
I mean that sounds like a great vehicle, especially if you're close to retirement. Mm-hmm. And succession planning and things like that are very big, especially when you're coming toward the end of your career in the business world. You really want to know what your exit plan is going to be, how you're going to get out. That's very key.
So what do you think with the changes that we've had the last couple of years to the tax code, has it gotten better for small businesses, or do you think it's gotten a little bit harder for small businesses?
Well, especially with the special COVID packages that they've put in, a lot of stuff has been very favorable for small businesses. For example, PPPs. I know we're not doing that anymore, but the PPP was a loan that was forgivable but never taxable. So it was just basically free money to small businesses. You can't get much better than that. EIDL, not quite free money, but if you qualified, first round access to up to $150,000, and I've seen businesses get as much as $2 million from the EIDL.
Wow.
So it's those are huge. Obviously, they put a lot of provisions in the tax code, both through the Tax Cuts and Jobs Act and the CARES Act, that were favorable to businesses. I mentioned about the 100% bonus depreciation. There's also a provision through the end of this year. Any business meals that you do are rather than 50% deductible like they normally are. They're now 100% deductible if you're eating out at like a restaurant.
Oh wow, I didn't know.
Yeah, that was part of the CARES Act. They were trying to encourage people to start going back to restaurants. So that was one of the big incentives that they put in for that.
Wow.
Like I said, I already mentioned 100% bonus depreciation. There's a lot of stuff that has gone in to favor small businesses recently. Obviously, there's also been stuff for larger businesses. There's certain things that, larger businesses get access to that you just can't, as small size, get access to. It's like, how are you going to become international as a small business, for example? If you're operating in one state, it's hard enough to operate there, let alone try to figure out how you're going to have some sort of Irish subsidiary or something crazy like that.
And then one thing, too, I wanted to ask you about, and this is something that, because I hear this all the time from people. People have the idea that as you get older, once you hit some golden age, you don't have to pay taxes anymore. So can you dispel that myth and kind of explain? So there is no age limit to when you have to pay taxes. It's based how old you are has nothing to do with how much you pay in taxes.
Yeah, so that's correct. There's a very large myth out there that, like, once you hit retirement, you don't have to pay taxes. Now there is some truth to it in a sense, in that, for example, if all the income you have is Social Security income, if that's all you have income, you will not be subject to any income tax because of the way that Social Security income is taxed. But if you have a pension or if you have anything like that, you will be taxed on that income, at least at the federal level. Now, I know a lot of our listeners that are in Illinois, some are not. If you happen to be in the state of Illinois, because I know this is a Chicago radio station, so if you happen to be in the state of Illinois, Illinois does not tax retirement income, and there are a few states like that as well that do not tax retirement income. If you're fortunate enough to live in a state like that, you won't pay income tax at the state level on retirement income. But if you have a pension or if you have Social Security, but then you also go pick up a part-time job or something like that, you will potentially be required to file a tax return, and you will potentially have to pay taxes on some of the money that you earn.
And is it a good idea always to file your taxes even if you don't pay?
Well, so here's the thing. If you are not required to file, and that typically means if you made less money based on the amount that's taxed than what the standard deduction is for your type of tax filing, then you don't have a filing requirement. You don't have a filing requirement. You're not necessarily required. It's not necessarily good or bad to file it, but I always tend to lean toward the safe side of things and say go ahead and file that return, because by filing a return, you're activating something called the assessment statute of limitations, in which the IRS only has 3 years to go back and look at your return and make any changes. If they don't do it in that time frame, they're not allowed to do it anymore. If you leave it here unfiled, they could technically, under the law, go back at any time and file what's called a substitute for return. And if they file a substitute for return, whatever they say should be on your return is automatically considered to be correct. And the only way to remove it is for you to prove it, basically, that they're wrong.
Wow. And give us your contact information. So if people want to use your services or get help or get some kind of advice, what do they do?
Absolutely. So our website is katzmilanec.com. That's KATZMILANEC.com. And our number is 708-914-8220. I'm going to say it one more time. That's 708-914-8220. If you're coming up against that deadline for the partnership or S corporation extensions, give us a call. We can get you filed. At the very least, what we can do is we can potentially file a zero return and then go back and amend that return so that we're not getting hit with those penalties. That's one way to kind of avoid having the penalties hit you as hard as they potentially could.
And then, so people that have like some tax headaches, people that owe money to the IRS, the people that haven't filed in a long, long time, what are some of the things you can do to help those people?
So when you are in that situation where it's without a business or an individual, we can file what's called a power of attorney, both on an individual or a business, and that's going to allow us to get the information that the IRS has on you or on your business, and it's going to allow us to represent you before the IRS. So we're going to be able to deal with any issues, and we're going to be able to get all the information. So, like, let's say you haven't filed for 5 years and you can't find any of your records. Well, we can get all the records from the IRS, and we can file the return based on what they're going to expect. So we can basically take care of those situations completely from the step of all you've got to give me is your name or your business's name, the Social Security number or EIN number, and the address. We take it from there all the way to completely filed and correct tax returns. And we can do that for anybody pretty much at any time. So if you're behind on your taxes and you're needing some help, definitely give us a call, 708-914-8220. Again, 708-914-8220.
And on that point, a lot of people are very nervous when they owe back taxes, because the fear is the IRS is going to come, break down their door and seize everything that they have, take their house, their dog, and everything else. However, I know there are situations where tax preparers, people like yourself, CPAs, are able to go in and reduce people's taxes. You hear that a lot in radio advertisements and things of that nature. How does that work normally? What are some of the tools that could be done to, say, if somebody has a huge tax liability, they owe a lot of money? How can that get knocked down to a smaller amount to pay the government?
So there's many ways that we can do that. First of all, if you're afraid they're going to come knock down your door, don't worry about it. The reason they probably haven't contacted you for several years, if you haven't been filing, is because they probably owed you money and they didn't want to pay it. So that's probably why they're not contacting you.
Wow.
Now, and they're not required to pay it if you don't file your tax return timely. There's another thing called the refund statute of limitations. You only have 3 years from the due date of return with all applicable extensions to claim a refund. If you don't claim your refund timely, you're not entitled to it. Even if you were owed $20,000, $30,000, it doesn't matter. Your commercials, all $1 billion is left on the table every year. That's the IRS's estimate. It's probably more like $2 billion when you actually prepare the return correctly. So, in the meantime, if you're in a situation where you're not knowing what to do, or you've suddenly gotten a bunch of notices that say you owe a bunch of money and you haven't filed for years, we can definitely help with that. One thing that happens is, like I mentioned earlier, you can get hit with substitute for returns. If you have substitute for returns, the good news is you're still allowed to file an original return. So in most cases, you're still allowed to file an original return. So you can get your records together and actually file the correct return. And a lot of times that can take hundreds of thousands of dollars and reduce it to zero. So another thing is we can go back and look at prior year returns. We can look at amending those returns and see if maybe all your expenses weren't claimed. Maybe there was something that was missed, and I've saved people hundreds of thousands of dollars doing that. One person, because they had separated from service at their job at the age of 55, after the age of 55, they had been hit with a 10% penalty, and under Internal Revenue Code Section 72, because he met the correct circumstances, he was not subject to that 10% penalty. So I was able to amend those returns and get him $50,000 of penalty money that he had paid in back as a refund. So that's just one example of something that can happen with amended returns. Another option that you have, if you just don't have the money to pay it, maybe you had a business for years and the taxes got to be too much and you had to shut it down because of the taxes, and you just don't have the money to pay it. Well, we can file something called an offer in compromise. Now, I've taken as much as $800,000 of tax debt before and taken it down to where the lowest number I've ever gotten anything down to is $118.
Wow.
We usually go for $500 though. So you can take 100, 150, 250, however much you owe, you can take it and you can knock it down all the way to like $500. And as long as you file and pay your taxes timely for the next 5 years, they'll take your refund up to the year of acceptance. So, like, for example, if we got an offer accepted today, next year when you filed, if there was a refund, they would keep that refund, but the year after, you'd get your refund. So, and as long as you make the payments, obviously, then you're out. And that is so ironclad and so airtight, not even the Supreme Court can open it back up, because there's been cases where they've tried, and the response from the Supreme Court was the IRS entered into a contract for this. We can't do anything about it.
That's good to know. So then what are some of the things that people can do to save money and to get some tax credits, to kind of rack up tax credits throughout the year? I know there's some things that changed recently with the new CARE Act and these different acts that came out, particularly with energy savings or energy home improvements on your house. So if you put a new furnace in or do stuff put insulation in your attic, what are some other things people can do to try to save money?
So a lot of the tax credits on the individual side have to do with kids. Now, this year especially, there was this filing year and the past tax year was they increased the child tax credit and they increased the child independent care credit. And the way they increased the child independent care credit was normally it's 20% of the monies that you pay with a cap. This year they removed the cap and they took 20% and turned it into 50%. Now, I'm not 100% sure that that's going to carry over to this next year, but if it is, it's a huge break for parents because, like for example, if you have a camp that you send your kids to that was, and each of the kids you had to pay $4,000 for, well, now you're getting $4,000 of a tax credit on your tax return at the end of the year. So it's a pretty huge credit for parents that are dealing with, pretty big childcare expenses right now. Another way, obviously saving for retirement helps. Businesses get a lot of opportunities. Really more deductions than credits is really what you're going to get as a business. But you can also do things within your own tax planning that are going to help you. For example, a lot of people with the Tax Cuts and Jobs Act that are homeowners that were used to getting an itemized deduction got written out of being able to get an itemized deduction, in part because of the state and local tax cap, and in part because of the the increase to the itemized the standard deduction. So as a result, if you're a married individual with a mortgage and you're paying, let's say, $18,000 of property taxes in Cook County, which is very common in Cook County, you are now not able to get an itemized deduction because you're not able to deduct all of your property taxes. Well, if you own a business, one thing you can do is you can lease a portion of your home to your business, and then you can take a percentage of your expenses on your home as deductions. So the things that you're not getting anymore on your Schedule A, like your property taxes, your mortgage interest, all that stuff, at least we can get a good chunk of that back as deductions for you, and it reduces your taxable income. And when you do that, it not only reduces your taxable income for the IRS purposes, it also reduces your taxable income for the state as well. So that actually gives you more of a tax benefit on both the federal and state side.
And one more time, give us your contact information so people can get a hold of you.
We are Katz Milanec. Visit our website, katzmilanec.com, KATZMILANEC.com, and our number is 708-914-8220. Again, 708-914-8220.
So what can you do to make your taxes less likely to get audited? Or can you do? Is there such a thing even to do that?
Well, there are certain things that we know commonly are audit red flags. For example, if you have first off a Schedule C, having a business that's either a sole proprietorship or that is a single member LLC that's taxed as a sole proprietorship, that automatically raises your risk of being audited. That automatically raises it a little bit. And then even further than that, having $2,000 or less of income with a $5,000 or greater loss on a Schedule C, that raises it even more.
So we're saying,
Rewind
that a little bit. So $2,000 of income,
having $2,000 or less of income with a $5,000 or greater loss.
How is that even
on
possible?
A Schedule C. How's it possible? I mean, you'd be surprised at what some tax preparers write. I mean, I have to tell people all the time, put on your logic cap. Would you be running a business that has a $2,000 a month loss? And every single one of the people I say that to says no. And your tax preparer seems to think the IRS will buy that, and so that's the kind of thing I see pretty frequently. You wouldn't think that, but some people, you see these people that advertise, I can get you this huge refund. Well, they're doing things that are not exactly 100% legal to do that, and things that are going to put you at risk of being audited. Now, another thing, if you're a business, especially an S corporation, and you don't have wages, I'm sorry? You don't have wages. You don't have wages on your business return. That's a huge audit red flag as well. And so little things like for example, another example, Schedule A. If you have itemized,
I got to step in. We're running out of time. So that was great information. Really do appreciate all the stuff that you talked about. We got to pick that up again with these red flags. That was a hot topic we kind of got into in the last second. Now, this is Dave Milanec. He's a CPA president and founder of Katz Milanec Incorporated and a military family member. Thanks for your time.
Thank you. Always a pleasure to be on.
This is America's Heroes Group. We'll be right back.